Hello traders, welcome back to yet another episode of our free Smart Money Concepts course. By now, we've covered a lot of important topics, such as structure mapping, liquidity inducements, order flows, and order blocks. Today, we're diving into something really exciting and incredibly useful for your trading journey: market manipulation. Market manipulation is the reason many retail traders face losses. But don't worry, there's a silver lining. By understanding how the market behaves, you can identify these manipulative moves and trade with them instead of against them. This approach can help you grow your small accounts with the power of smart money. In today's episode, we're going to focus on a crucial manipulation technique used by institutional players. It's called the institutional candle, also known as the institutional funding candle, IFC. Now, whether you're a beginner or someone with more experience, this concept is one that can seriously elevate your trading game. We'll go over what an institutional candle is, why it forms, why it works, and most importantly, how to trade with it. So make sure to stick around till the end of the video to get the full understanding. What is an institutional candle? Alright, let's start with the basics. Institutional candles, IFC, are simply the last opposing candles, or groups of candles, before a big directional move in the market. These are the moves where the price action looks like it's going in the opposite direction, but really, it's just grabbing liquidity for the bigger move ahead. You'll often hear them called bangers candles because they literally bang through market structures before shifting direction. Institutions, or big players, often do this to absorb retail trader liquidity. The idea is that retail traders get caught in the wrong place at the wrong time, and the big players can use that liquidity to push prices in their favor. Why do these candles form? Now, you might be wondering, why do these candles form? Well, the one-word answer is liquidity. Here's the deal. Whenever there's a buyer in the market, there must be a seller, and vice versa. For prices to move, there needs to be someone on the other side of the trade. Big institutions know this, so they manipulate the market to generate liquidity at the price levels they want. Here's an example. Let's say institutions want to sell at higher prices. To do that, they need retail traders to buy from them. So, they'll push the price higher, trigger the stop losses of those already in sell positions, and get more people buying into the market. This creates liquidity that the institutions can use to sell their positions at better prices. In a nutshell, the institutional candle is part of a liquidity sweep to grab orders from retail traders. This is often referred to as the accumulation manipulation distribution, AMD, process. Why do these candles work? You might still be asking, why do these candles actually work in the market? The key reason is that these moves represent a loss for the smart money. Here's how it works. When big institutions want to buy at lower prices, they need to get more sellers into the market. So they push the price down, triggering stop losses of retail traders who are trying to buy. But the institutions aren't trying to stay in their sell positions, they're collecting liquidity to switch their positions to buy at lower prices. Once all that liquidity is absorbed, they exit their short positions and the price starts to rise. This is why these institutional candles are so powerful. They allow institutions to enter and exit trades with little risk while creating a large directional move. How to spot institutional candles? Now, let's talk about how to identify these candles on your charts. Spotting institutional candles is simple once you know what to look for. First, pay close attention to the bodies of the candles. These are the areas where the big volume occurs. The wicks, on the other hand, are mostly filled by retail traders and not the big institutions. Here's a pro tip. When scanning your charts for institutional candles, ignore the wicks for now and focus on the body of the candles. These bodies represent the liquidity zones that big institutions target. How to trade with institutional candles? Now, we've got a good understanding of what institutional candles are and why they form. But how can you use this knowledge to trade successfully? Here's the strategy. You'll want to mark up your major swing points formed by these candles. For example, in an upward trending market, you'll notice that the last down-close candles before the price moves higher tend to be respected. In a downtrend, the last up-close candles before the price drops are important too. Step 1. Identify the swing points formed by the institutional candles. Step 2. Use the Fibonacci tool to mark the range of these candles. Plot it from the high to low for a bearish move and low to high for a bullish move. Step 3. Focus on the 0%, 50%, and 100% levels. These will create your tradable zone. You want to place your trade either at the opening price of the institutional candle or around the 50% retracement level. Stop loss and target placement. Let's talk about stop loss and targets. For a sell trade, your stop loss should go above the highs of the institutional candles, preferably above the wick. For a buy trade, place your stop loss below the lows of the institutional candles. For your take profit, focus on the next area of interest. This could be the next high or low, support or resistance, or liquidity zones where price can move to next. Let's go over a simple example to make things clearer. Imagine the price is in consolidation, and it forms equal lows. The price then breaks below these lows with deep wicks to grab the liquidity. Once that liquidity is absorbed, the price starts to move higher. Now, using the Fibonacci tool, we mark the range of the last downclose candles and look for a potential entry at the 50% level. Once the price comes back to our marked range, we place our buy orders at the 50% retracement level. As the price moves up and hits our first target, say, a recent swing low, we close the trade. But remember, these trades can be very dynamic, so you need to stay alert. To wrap up, understanding institutional candles and how to spot them is a game changer. It helps you trade with the smart money, follow the order flow, and spot market structures more accurately. Make sure to backtest this strategy on multiple charts and practice with paper trading before going live. Remember, patience and practice are key. If you found this video helpful, don't forget to like, share, and subscribe to stay updated on all things smart money concepts. Also, leave a comment below to let us know what you think or if you have any questions. We'd love to hear from you. That's all for today, traders. Stay smart, and I'll see you in the next video.